What's up, builders? This is Raise the Bar Radio, where we talk about building wealth, raising capital, and all in all, raising the bar in your business and your life. This is the No BS podcast for capital raisers, investors, and entrepreneurs who are serious about scaling their business and living life on their own terms. I'm Seth Bradley, securities attorney, real estate investor, and entrepreneur, bringing you world-class strategies from the best in the game. If you're ready to raise more capital, close bigger deals, build a better you, and create true financial freedom, you're in the right place. Let's go. Welcome to Raise the Bar, elevated conversations around entrepreneurship, capital raising, and real estate. I'm Seth Bradley, your grateful host. Today on Raise the Bar, we've got a legend in the real estate game. Mr. Jay Scott is a best-selling author, longtime Bigger Pockets icon, and an investor who's bought, sold, and managed over $150 million in real estate. He now runs Bar Down Investments, taking those same principles to large-scale multifamily and commercial deals. This dude has shaped an entire generation of investors. Jay, welcome to the show, brother.
That was a very kind intro. Thank you, Seth. How you doing?
Doing great, man. Good to see you. Good to see you, man.
Thrilled to be back.
Hopefully we get to see each other in person again soon.
Absolutely.
All right, man. Well, look, I always like to frame this question to kick things off because we're entrepreneurs, real estate investors. We have a lot on our plates, but when a stranger comes up on the street to you and have a conversation and ask you what you do you tell them?
You know, it's funny. I know a lot of people have elevator pitches. They're prepared for that question. I feel like every time I get asked that question, I'm kind of like a deer in headlights. Like, how do I want to answer that question to this person on this day at this time? And it changes, but normally I just say I am a full-time investor. And what I find is if somebody is interested in finding out more information from there, they'll ask questions, I'll go deeper. But if they're not, I'm not wasting their time by saying that, and they just move the conversation on to whatever the next thing is they want to talk about.
Yeah, for sure. I struggle with that question too, and it depends on when you ask me and what's going through my mind at the time. I used to always say I'm an attorney, and then for a while I was like, I don't want to be an attorney anymore. I want to be an investor. So I specifically did not say attorney, and now I'm back to, yes, I'm an attorney and an investor, and we start talking about real estate and raising capital and things like that.
Yeah.
Well, what do you got on your plate nowadays, brother? I know you've come a long way. You've wrote a ton of books through Bigger Pockets, and that's kind of how you staked your claim with flipping tons of houses and just being the expert there. And then I know you kind of transitioned over to multifamily. But what's that journey been like for you? Like, let's go back and say, why did you make that switch? Because a lot of folks out there start with that, especially active investors. We're buying long-term rental, single family, maybe doing some fix and flips, and then sometimes we're like, okay, where do we go from here? What was that journey like for you?
Yeah, and it's actually pretty simple. I burned out. Started flipping houses in 2008, did about 450 houses between 2008 and 2017, 18, and I got tired. Flipping houses is a job, and don't let anybody tell you otherwise. I mean, certainly you can build a business around it, but it's really hard to build a business that you are not integral in. It's very hard to build a business where you hire everything out and you just kind of be the CEO, simply because it's a business with relatively low margins compared to what it would cost to bring in folks to run each piece of the business. And so what I found was that I was working 10, 12, 14 hours a day in some cases. And I got into real estate for the exact opposite. I got into real estate because I wanted better work-life balance. I came from Silicon Valley, where I was doing the tech thing with my wife, and we left Silicon Valley because we were working too many hours, we were traveling too much, and then I found myself flipping houses in the same situation. So 2018, decided to make a transition. Didn't know exactly what I wanted to do, but I had a lot of cash from flipping that I needed to put somewhere. And I decided, after doing some research, that the best risk-adjusted returns on the planet were in the multifamily space. So I looked to invest in multifamily. In my course of investigating how best to invest in multifamily, what I realized was I don't just want to hand my money over to other people. I'm a control freak. And so what I decided was that I was going to manage my own investments, invest in my own deals, but I wanted to do larger deals again for the same reason I wanted to get out of flipping. I didn't want to be kind of a one-man show. And so I reached out to a friend of mine, Ashley Wilson, who was running a company called Bar Down Investments, and she was syndicating large multifamily, and I asked her if she'd help me learn the business. And so I basically did a year internship under her. Basically, we agreed she would teach me the business, and I would kind of bring my knowledge and skill and my Rolodex and my wallet and help out wherever I could. And after about a year of working together, what we realized was we actually worked really well together. We had a set of amazingly complementary skills. The things she hated doing, I was really good at. The things I was really bad or hated doing, she was really good at. And so 2019, 2020, we decided to partner up formally, and today, we run Bar Down Investments together. We own about 1,200 units, mostly value-add multifamily, but we're getting ready to kick off our first large development deal, a 351-unit multifamily development outside of Dallas, which will hopefully launch in the next few months.
Man, ton to unpack there, dude. Going back to flipping, how many were you doing a year kind of at your peak?
At our peak, we probably did 50, 60 a year. By ourselves. We were also partnering with other people to flip some. So I add in a few there that we weren't necessarily leading, but we were involved in. And so
yeah,
a typical year, we probably did 20 to 30 ourselves and another 20 to 30 with other people.
That's insane, man. I can't even imagine. I was doing maybe 3, 4, 5 a year. So multiply that by 10. That's crazy.
Yeah, it took a toll.
Yeah, that's insane. Anything about your tech background that you used when you kind of made that switch from Silicon Valley to real estate? Was there anything there you were able to leverage as far as your skill set?
Yeah, I mean, in the tech world, I managed businesses. I have an engineering background, but by the time I left technology, I was basically managing, and I was leading teams. I wasn't necessarily an individual contributor doing the work myself, and I think that's what helped me most when I got into real estate. Part of it was I didn't know how to swing a hammer. I was an electrical engineer, but my wife would joke that I couldn't change a light bulb. And so when we decided to flip our first house, a lot of people, they have some contractor background or some construction background, and they'll go in and they'll paint the house themselves, or they'll do the electrical themselves, or they'll do the carpentry themselves. I couldn't do any of that. In fact, I didn't even know the right questions to ask. And so my wife partnered with me for that first 10 years. Basically, we were forced to go out and bring in talent that could help us navigate all that. We had to hire that out. We had to hire out the finding deals. We had to hire out the contracting work. We had to hire out basically everything. And that's what allowed us to scale. Because we didn't get bogged down in the day-to-day. I didn't get stuck painting a house. I didn't get stuck walking the aisles at Home Depot. Instead, I did what I was good at, which was I brought in smart people, manage different parts of the business, and let them actually put their expertise to work and figure out how to build, grow, and scale the business.
I love that, man. I personally got bogged down with that stuff because I grew up in rural West Virginia, and I'm a handy person. I'm not a contractor or anything like that, but I'm handy. Go figure this out, fix this. I'm like, yeah, I'll figure it out. I can fix that. I can do that. And especially when you're starting out, you're kind of trying to save every dollar. So it's like, shit, I'll just go do it, right? And
I credit being an idiot to a lot of my success in real estate because I was too dumb to actually know how to do any of it myself.
That's hilarious, man. I think a lot of people can relate to that as far as, thinking about what you're good at in your W-2 or your daily job or your career, and then thinking about, well, how can I apply that skill set or whatever it is, that leadership quality, that management skill to something entrepreneurial. So if that's real estate, if that's starting a business, there's a lot of things that we learn in our W-2s and our day jobs that we can leverage and use. We just have to really think about what those things are.
Yeah, and I would take it one step further. I would say a lot of people think about real estate as something you can do on the side. They don't think of it as a real business. They think of it as an investment, and certainly real estate can be an investment. But when you're flipping houses, it's not an investment. You're running a business, and nobody would go out and say, "Hey, I'm going to open a restaurant," without understanding how businesses work, without understanding how supply chains work, where you're going to get your inventory, how financial statements work, how cash flow management works, how hiring people and managing people and doing payroll, how all of that works. Nobody would think to start a quote unquote real business without understanding all that. But people think they can go into real estate, and as long as they know how to swing a hammer, they don't need to understand the real business part of it. And I would argue that that's probably the single most important part. If you want to get into real estate, you're a business owner. And you need to know the same things as all other business owners. You need to know how to read financial statements. You need to know how to raise capital. You need to know how to manage cash flow and inventory and people and all of those things. And if you can do those things and you can do them well, you're going to be in the top 5% of real estate investors, even without a day of actual real estate investment experience.
Pardon the interruption, but we don't do ads. Instead, know that if you're raising capital for real estate, my law firm, Raise Law, is here to give you the expert legal guidance you need to raise capital compliantly and structure and close your deal. And if you're looking for a done-for-you fund-to-fund solution, TribeVest is the industry's only all-in-one setup and fund administration solution. Visit raise.law and tribevest.com to learn more. Totally. There's a ton of winging it out there. And I think people just kind of have that misconception like, all right, and it's hard to get started. So I think that kind of comes with the game. Like, it's hard to get started. So you're like, okay, what do I need to do first? Like, let me try to find a property. Let me like do some research. Let me look on Zillow, whatever it is. But it's just really hard to get started. So I think there's a lot of winging it, and people are just like, oh, this one looks good, and then they get themselves into trouble and don't treat it like a business. Or maybe they haven't ran a business before, so they don't even know what that means. But when it comes down to if you want to be successful in the long term, maybe you get lucky once or twice, but long term, you have to treat it like a business because it is.
Absolutely.
Yeah. And it's crazy because you're talking about fixing and flipping and how that kind of turned into 12 or 14-hour days job. That's not why people get into real estate generally, right? Like
Absolutely.
People think real estate, they think financial freedom, they think investments, they think, all right, I can get out of my W-2 and I can, go to the beach and hang out and with family and friends and do all that. But a lot of people end up getting sucked into fix and flips because they see it on HGTV, and it's not that.
Well, here's what I like to tell people. If you're leaving your W-2 job to get into real estate, presumably a big part of that, I mean, there's a lot of benefits, but a big part of that is to make a lot of money, right? And so what I ask people is, how much money do you want to make? Like, what is your hourly earn that you expect? And if you're going to work 40 hours a week, about 2,000 hours a year, like, you want to make $1 million a year? If you want to make $1 million a year, you need to make $500 an hour working full time. Great. So now let's say that's your number. Let's say you want to make $1 million a year. Now you've got this number, $500 an hour. Now you need to find those tasks in your business that generate $500 an hour. And you painting your flips, you're not generating $500 an hour. You're saving the $25 an hour that you'd be paying to a painter. And so if you do it yourself, you're effectively earning $25 an hour. You didn't get into real estate to earn $25 an hour, so don't paint that house yourself. Figure out those tasks that will generate $500 an hour. In flipping houses, there's basically two things that generate $500 an hour. You have to be great at finding deals, because every deal you find is going to be worth tens of thousands, maybe even hundreds of thousands of dollars. And two, you need to be able to raise capital. Because if you can raise capital, you can do more deals. You can find more of those $10,000, $50,000, $100,000 profit deals. And so if you want to be making $250, $500, $1,000 an hour in real estate as a house flipper, you need to be focused on those two very important things, finding deals and finding money, because those are the things that generate you $500, $1,000 an hour. Hire everything else out, because most of the other stuff can be done. You can be hired out for $25 or $50 an hour, and that's not why you're in this business.
Totally. Let's fast forward to multifamily. You've kind of made the switch. there's a lot of different opinions out there on multifamily, especially right now. Where do you see the market right now, specifically multifamily? We can get into development as well, because development and multifamily. But what are you seeing out there? Some people are, the two opinions I see right now are, one, there's no good multifamily deals, or not very many. Stay away from it. The margins are too thin right now with the interest rates and everything that's going on. The other opinion is, hey, it's really tough, but if you can land something and hold on to it, it's going to be one of those, you bought it in 2010 and you held on to it for the next 5 years. Where do you land on that spectrum?
Yeah, so let's step back a little bit. Multifamily was super hot from 2013, 14, 15, somewhere in there, to 2022, the beginning of 2022. If you bought a large multifamily deal between 2015 and 2021, or sold it in that time period as well, you made a lot of money. I have investors, potential investors, who ask me about my track record, and if I'm going to talk about the deals that we sold before 2022, I always put the disclaimer on, don't give me credit for that. A monkey could have made their investors millions of dollars back then, because it was so easy. The market just kept going up, and it would correct for any mistakes you made. So everything was great through about, actually specifically, March of 2022. And then in March of 2022, we all know what happened. Inflation kind of spiked and interest rates went up. And we saw the largest increase in interest rates in history, from 0% essentially to 5%. We saw multifamily debt interest rates go from essentially 3%, 4% to 7, 8, 9%. And people started to struggle. Basically, what we saw was multifamily values dropped between March of 2022 and August of 2022. Just those few months dropped about 20 to 25%. To put that into perspective, in 2008, the entire 2008 recession, values only dropped between 20 and 25%. So we saw a drop between March and August of 2022 that was as bad as the multifamily drop we saw in 2008. And then things started to level off, but we've seen a decrease continue since then. Between August of 2022 and last few months, we're down another 10%. And so we're down somewhere between 30 and 35% on a national level in multifamily over the last 3.5 years. That is a tremendous correction. Call it a recession, call it whatever you want to call it, but it was a tremendous downturn in multifamily. And a lot of investors don't realize that. If you're a passive investor in deals and you're looking around, you see, well, the stock market's going through the roof, crypto's going through the roof, single family values are going through the roof, asset values in general are going through the roof. People don't realize that multifamily really has taken a huge hit over the last few years. Well, it feels like we've probably finally bottomed out. Cap rates have kind of leveled off and are actually starting to come down slowly, but come down. We're starting to see positive rent growth for the first time in a few years. That's nice. We're seeing expenses start to level off. We actually just got our insurance renewal for this year, 12% less than last year. Who would have thought insurance would be going down? So that's fantastic. So we're finally starting to see some reprieve from what happened a few years ago, but we're still in a situation that if you bought a property 2019, 20, 21, even 2022, you're sitting on a property that you've probably lost a lot of money. You might be underwater on your loan, and you're not going to sell that property unless the bank forces you to sell it, because you're not going to be making money for you or your investors. And so we have a lot of multifamily owners out there that are just sitting on properties waiting for the market to improve. They're not willing to sell at any reasonable price that a buyer is willing to pay. Buyers obviously aren't willing to pay the same prices that they saw in 2020, 2021, 2022. And so what we see is this kind of lack of transaction volume where sellers aren't willing to come down, buyers aren't willing to come up, and nothing's transacting. And so that's why a lot of people say it's really hard to find deals these days, because sellers aren't, you can say they're not being reasonable, but sellers are saying the buyers aren't being reasonable. And so at some point, there's going to be a reckoning. At some point, the banks are going to step in. One of two things are going to happen. The banks are going to step in and say, hey, you guys are underwater on these deals. You're behind on your payments. Interest rates are still high. You have to sell the property or we're going to foreclose. Or two, the market's going to improve, values are going to go up, and sellers are going to finally start getting the prices that they want. But until one of those two things happens, I suspect that deals are going to be few and far between, and there's just not going to be a lot of transaction volume.
Totally agreed with all that. That was awesome, man. That really paints the picture. Like, agreed with everything there. Things are starting to stabilize a little bit. Especially I'll say like in the capital raising game, it's also really hard to transact.
It is.
It's hard to raise capital because all these investors that are stuck in these deals from 2019 to 2022, 2023, they're not getting any cash flow. They're not getting any payouts. Perhaps there were capital calls. Perhaps they already sold for a loss. So those investors, their confidence is shaken. So these people, a lot of these people that raised a lot of capital in those years aren't even in the game anymore. They went
Yep.
back to their W-2. They're not even doing this anymore. But it's really tough out there to raise capital. How are you able to do it? What are you seeing out there? Because you've got a new deal on your table. It's a big deal. Lots of capital to raise. What gives you the confidence to be able to move forward with something like that?
Yeah. So, one, this is the first deal that we've raised for the first big deal that we've raised for in about 3 years. Because again, when things started to go downhill, we got conservative. We continued to make offers. We've been making offers since we started in this business. But as I pointed out, what buyers are willing to pay, sellers aren't willing to take. And so we haven't come close to getting anything for the last few years. We finally have a new deal under contract, new development project, and yes, it's a large deal. What we're finding is a couple things. One, normally our repeat investor rate is somewhere between 60 and 70%. So 60 to 70% of the money we have coming into a new deal is from existing investors, people who have invested in other deals. For this deal, it's closer to 40%. So just like you said, a lot of our investors are licking their wounds. They're not looking to invest right now. They're dealing with legacy properties that aren't paying distributions. In some cases, they're dealing with capital calls. We've been fortunate that we've kind of avoided any major issues with our properties, but we haven't been paying distributions like most of the properties for the last couple of years. And so investors are kind of sitting back and waiting to see what's going to happen with the market. And so we're not getting nearly as much repeat investors as we normally do. On the other side, we are seeing a lot of new investors that are entering the market. There are a lot of people who didn't get stuck in 2022, 3, and 4 who are like, okay, maybe we're now at a bottom in multifamily real estate. Maybe now's a great time to get in. I actually think it is a good time to get in. And so we're going to dip our toes. The problem is that a lot of those investors, this is their first investment. And so they don't want to invest $100,000 or $200,000 or $500,000. They want to diversify. They want to put as little money into every deal as possible while they learn the business, figure out how this works, and until they get comfortable with different operators. And so we are seeing a lot of new investors coming into our deals, but most of them are writing much smaller checks than what previous investors did back when the market was stronger.
Yeah, totally agree with that. I mean, at TribeVest, we see tons of new people. We see tons of new capital raisers. We put together tons of new fund of funds. So we see a pretty big, broad swath of the market and the people that are out there transacting. And it's almost like a reset. It's almost like a reset. Like we're seeing new capital raisers that weren't here 5 years ago. We're seeing new passive investors. This is their first deal. So there's kind of this really big education hurdle that you have to overcome as well. If you're somebody like myself that's putting together compliance and vehicles for people to raise capital into, or someone like you that's been in the game for a long time and raising capital for a big project. There's just, I don't know if you're seeing that too, but there's a lot of education involved here because it's not repeat investors. It's not the same people that have done this over and over again. It's new people that are interested, and you've got to teach them kind of the ropes from ground level.
Yeah, and one of the reasons we really like TribeVest, and you're not paying me. This isn't a marketing spot for TribeVest. I'm not running an ad here, but I love the model because for so many years the way capital raisers were operating in this business was they were coming in, they were bringing capital to a deal, they were getting a GP position for bringing capital to the deal, and for anybody that's in this business, they know that's illegal. You can't receive payment, compensation, equity in return for bringing capital, unless you're a licensed broker-dealer, and most people out there aren't. And so they would get around that by saying, well, I'm not getting paid for bringing capital. I'm getting paid because I'm doing investor relations, or I'm getting paid because I'm helping with asset management. These things that they're getting millions of dollars, and the work that they're doing doesn't justify the millions of dollars. The SEC is smart enough, if they investigate, to know, yeah, you got paid for bringing capital. And so what we're starting to see is a lot of people in this business are worried that trading that capital raising for GP equity over the last couple of years, if those deals don't do well, if the investors go to the SEC and complain, if the SEC investigates, and if the SEC finds that those capital raisers were doing it illegally, there are a lot of people in this business that are potentially in a lot of trouble. And so TribeVest, for us, and luckily we've kind of steered clear of all that. We've never really used capital raisers in our deals, but TribeVest has kind of provided us a mechanism for legally being able to bring capital to deals. And the way you do that is, instead of offering GP equity to a capital raiser, you basically have them come in as a limited partner, as a fund, and you carve out benefits, you carve out a structure in your deal where they can get compensated for bringing a large LP check. And so one of the things that we did on this deal in anticipation of needing these legal capital raisers is we created a separate class of shares where we said, if somebody can bring $1 million, one, we're going to give them a 5% discount on shares. So if somebody brings $1 million, they immediately get $50,000 back. They can share that $50,000 with their investors, or they can take that as the fund manager as part of their fee. In addition, they're getting a better pref. They're getting 2% higher on the pref. They're getting a better split, 80-20 instead of 70-30. And so there are benefits for somebody to come in and say, I'm going to put together a fund, I'm going to bring $1 million or whatever, and now my investors can make the same amount of money they would make investing directly, maybe even a little bit more, and I can get compensated nicely for putting together that fund. And historically, we've always been able to do this, but historically putting together that fund is really expensive. If you go to a typical securities attorney, you're going to pay $15,000, $20,000 for your PPM and all your documentation. You're going to pay $5,000 or $6,000 or $7,000 a year for your accounting, for your K-1s, for your management. You're going to have to handle all the distributions yourself. And the nice thing, obviously, about TribeVest, and again, this isn't an advertisement, but the thing we love about TribeVest is I can go to these legal capital raisers and say, hey, flat fee, not that much. They'll handle distributions, and so it's a lot easier for us to find these legal capital raisers to come in and bring large checks to our deals, which kind of covers the gap that we're seeing from all these new investors that want to write really small checks.
Right. Man, I need to cut that clip, send it to TribeVest. You did just create an advertisement for us. You nailed it. I don't even have a lot left to say about it.
Well, I'll give you my address for the commission check.
Will do, man. Will do. Yeah, you definitely identified like a big issue with what we've been doing over the last 5-10 years, whatever it might be, with that co-GP model and just abusing it. It ran rampant there for years. We're entrepreneurs in the industry, investing in real estate, raising capital, and we tend to push the boundaries, and that's what has happened, right? We took a model that was legal, active partners getting together, bringing their skill sets, working together, buying a property, and that's a real GP. There's not really a co-GP. Co-GP almost has a negative connotation to it now. And now we just abused that over and over again and got to the point where people were just raising capital and getting paid for it, and that's illegal. It's non-compliant.
And the problem is, I think we had a lot of people coming into the business that they didn't go in with this idea, hey, I'm going to break the law and hope I don't get caught. I know a lot of people that did this that have no idea that what they were doing was literally illegal. What they were doing could literally get them in trouble with the SEC. And so there are a lot of people, it's again, not a trying to run afoul of the rules, but just not knowledgeable enough to realize that they were running afoul of the rules.
Totally. I don't think there was any intent there. At least initially. I think later you get into it and you learn, you're like, this doesn't feel right, or I've heard this from this person on this podcast. The intent's not necessarily there, but that doesn't mean you weren't breaking the law. It's insane that people, when you start taking other people's money, you really have to do your due diligence. You really have to be careful. You really have to understand the risks and the laws around it. And people just didn't do that. I think it was just kind of this crazy time when everybody was making money and all the deals worked, and
Exactly.
everybody wanted to invest, so everybody wanted to get into it. But luckily, I think that it has switched. It has changed. You don't see that co-GP model getting abused nearly as much.
Yep.
Now there are still people that are out there, and you have to explain to them like, hey, you can't do this, and it's really like an education thing at that point. But it's not running rampant like it was, and I think a lot of it is because we've made the fund of funds available to people and made it economical, affordable, and not complicated. Because before, fund of funds has always been there. It's always been an option. One of the earliest people I heard talking about it was Hunter Thompson. He used to talk about it back in the day, and you would hear it and you'd be like, that sounds great, but it costs $20,000 from a securities attorney. Oh, I've got to go find a CPA that understands this. Oh, I've got to put together my own fund. It's like, why don't I just go co-GP with somebody and they do all this stuff for me, right?
Absolutely.
But now we've kind of transitioned over to companies like TribeVest, where we do all those things for you. So we're the fund administrator. We're helping you with investor relations. We do the formation of the documents or the formation of the entities and draft your offering documents. I mean, everything is included. So it's kind of like taking that co-GP model where a lot of things were done for you and you could focus on relationships. And we're doing that same thing for you from a vendor standpoint.
Yeah, exactly.
Yeah, and the big thing for lead sponsors too is the separation. Like for someone like you, it's the separation. You're not bringing somebody into your LLC that's an active partner or that could scuttle your deal. They're starting their own fund, totally legally separated, and you don't necessarily have to worry about what they're doing. Now, of course, you want to try to make sure they're doing the right things, and going through TribeVest really helps, but. Like it's totally separate. You're creating a level of separation there which protects you.
Yeah, and in the old model, it's a risk both ways. It's not just the lead sponsors bringing in co-GPs and putting the deal at risk because that co-GP might screw something up, but it's the other way around. If you're the co-GP, you're basically tying your reputation to the lead sponsor and saying, hey, I've vetted this person enough that I'm willing to come in as part of the deal. If that person did something illegal, like using you as a co-GP in a way that wasn't legal, well, everybody on that deal runs the risk of dealing with SEC, even if there's something that you as the co-GP had nothing to do with the impropriety, just you being a GP on the deal, you now have liability. And that's one of the nice things about being an LP. That's the important thing. I mean, the L in LP is limited risk, limited legal risk. And so as a GP in any capacity, you've got risk. And so it goes both ways.
Yeah, totally. I mean, looking back, it's crazy. I mean, you'd have, 5, 10, I've seen lots more. I've seen up to like 15, 20 people co-GPing on a deal. And just thinking about that, even from a co-GP or the lead sponsor's perspective, like there's so much risk there. Like you don't know these people at all. Yep. Like you're just like, oh, they're going to bring in some investors. Great. And you bring them into your business. You don't know these people. You don't know what they're going to do. You don't know what they've done. You don't know who their investors are. And you're all the same at that point. Like you're all partners in an entity, you're business partners, and if they do something wrong or they stop communicating with their investors, those investors are your investors.
Yep.
So those investors are going to sue you too. It's insane looking back at those sorts of things.
Yeah.
Let's switch gears a little bit, man. Question I really always ask all my guests is, in a different, I'll call it a parallel universe. What's a different reality for you today? So I'll give you an example from my perspective. I went to med school for 1.5 years and then I dropped out because I absolutely hated it. Then I ended up going to law school and getting into real estate and all those sorts of things, and entrepreneurial journey started. If I would have finished medical school, totally different life, right? Not worse, not better, but just different. Like what's one of those pivotal moments for you, and what's that new reality look like?
Yeah, so I've kept one kind of toe or foot or leg in the tech world since I've left. And I do a good bit of advisory work for startup technology companies in the real estate space, which a space often called prop tech. So imagine like the Zillows or the Redfins or those companies that are technology and real estate kind of combined, but on a much smaller scale. And I do advisory work for those types of companies. When I left flipping in 2018, one of the things that I had considered was kind of heading back into tech, more as an advisor or a consultant. And so if I had not found multifamily back in 2018, I probably would have spent much of the last decade kind of back in technology. And so I think in an alternate universe, either I don't leave technology or I find myself back in technology, which, don't get me wrong, it's an amazing place to be, but I love real estate.
Love that, man. Love it. What's one limiting belief that you've had along the way and you've had to overcome it?
I have limiting beliefs every day.
Yeah.
Every day, I grew up, basically, I lived in apartments. And so for me, owning apartments was that was the other side of the world. And thinking about those people that buy large real estate, those people that can raise millions, tens of millions, hundreds of millions of dollars, that's somebody different than I was or even am. I think of those people as they have some background that I don't have. They have some skill set that I don't have. They have some connections that I don't have. How am I able to do this thing that, like, in my mind was reserved for the elite of the elite? And so it often kind of creeps up into my psyche, like, am I qualified to be doing this? Do I have the pedigree? Do I have the background and the relationships and all of that? And I have to remind myself that all of the people that I think of as special that could be doing that, they all started the same place I did. They were all born without any knowledge. They all went to school. Sure, some of them probably had it in family legacy, but a lot of them, they did it the way I did it. And that was, they built relationships and they learned along the way, and they started small and they grew and they built relationships and they built a reputation. And so I just have to remind myself that even though it feels like I'm in a world that I don't deserve to be in, everybody probably feels that way at some point, and we all deserve to be in that world if we're willing to put in the work, if we're willing to gain the knowledge, if we're willing to build a great reputation.
I love that, man. I had a similar experience growing up. The people around me that owned real estate were like the local politicians, and they owned all the local businesses. They owned like the grocery store and the gas station and all the apartments in town. And I was just like, that's not me.
You're either
That's not
born
my
into
family.
it or you're not. It's
Right.
easy to think that way.
Yeah, insane. And it took a long time to kind of get that mindset and over that hurdle, because I just had that W-2 mindset all along, where just get the best job you can get, and that's the only way you can be successful. So it takes a long time.
Absolutely.
All right, Jay, it's been great having you on, brother. Where can our listeners find out more about you?
Yeah, jscott.com, letter J, SCOTT.com. That'll link you out to my email address, everything I have going on. If anybody out there wants to raise capital for an amazing development opportunity, you can legally raise capital with us by working with TribeVest and bringing an LP fund. Feel free to reach out to me. Happy to talk to anybody, and if I can help anybody in any other way, don't hesitate to reach out.
Absolutely. Thanks, Jay. Appreciate you.
Seth.
Thanks for tuning in to Raise the Bar Radio. If you enjoyed today's episode, make sure to subscribe, leave a review, and share it with someone who needs to hear it. Keep pushing, keep building, and keep raising the bar. Until next time, enjoy the journey.